Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It's lecture time. This week's topic, guys, the 3 biggest mistakes that traders make. Look, let's be honest, traders make a lot of mistakes, a whole lot of mistakes, especially new traders. But these 3 that we're going to talk about are the ones that are costing you the most money. These are the types of mistakes that if you continue to make, your future as a trader will be pretty grim, pretty dim, and you don't want that, okay? These are egregious types of mistakes. And the thing is, many of you don't realize you're doing it, or you don't really think they're mistakes. So it's a big deal to learn what these are. So first, we're going to talk about a few trades that we recently took so you guys can understand what great trades look like. Then we're going to get into these 3 big mistakes that you guys are making, okay? And trust me, this can be the most amazing, wonderful, incredible, flexible business in the world when done right. But when done improperly, when you make these kinds of mistakes, it's going to be one of the worst experiences you've ever seen, okay? Again, this business is amazing and wonderful, but it can also be terrible and brutal if you're not careful, all right? So stick around. It's a great lecture, guys, and it will hopefully change the trajectory of your trading future. If you like these videos, click that like button, hammer that subscribe button, guys. It's an awesome channel with a lot of great stuff on it, all right? I'm Jared Wesley of Live Traders. Let's get to it. This week's lecture topic is the 3 biggest mistakes traders make. Traders make lots of mistakes. Let's be honest. We all do. All right. As traders, we've made hundreds of mistakes. Some of those mistakes hundreds of times over. So thousands of mistakes. But there are a few, 3, 4, 5 mistakes I think that too many traders make, and it's costing you a great deal of money. The good news is I think some of them are easily fixable. There might be one that's less or not as easy to fix, but these are mistakes that I've rarely seen a trader not make at some point in their career, which means just about everybody has made these mistakes. So we're going to get to that, but before we get into the 3 biggest mistakes that traders make, I have about 4 slides or so of recent charts of things that we've traded recently that I want to go over with you guys, because I don't know that you're quite getting what I'm speaking sometimes. There is a consistency to the types of trades that we're taking. And I think sometimes people think there's randomness, and there's not as much randomness as you might think. There's a very detailed approach to why we take what we take. All right, so I want to go over 3 or 4 trades, okay, and then we'll get into the 3 biggest mistakes that traders make. But I think the review of these 3 trades will be very, very helpful for you guys, okay? So what should we expect here? We did something similar last week with different trades, and I think this is something that as long as I remember to do so, that I want to do more frequently, maybe each week, because I think it's good to review recent trades that we've taken and why we've taken them, especially if I can pick out 2 or 3 each week that are exceptional examples, so to speak. So this happened, I don't know, a couple days ago on Meta. We have Meta at the top on a 2-minute, and at the bottom we have the Qs. And the reason these charts are slightly off here is just because I wanted to line the time up exactly, right? 2-minute here, 2-minute here, daybreak here, daybreak here. So these are lined up bar by bar, okay? The first thing I want to focus on, all right, is the Meta 3-bar play here. I wouldn't necessarily call this first bar a wide range bar, but it's an above average bar, and the following bar has a bottoming tail, and you could have taken this at like 303.25. Now, to be clear, if you're going to be this early and this aggressive, I would give it the low of the day. I know out in professional trading strategies it says put your stop loss under the second bar's low, and if this was a little bit later in the day, then I think that would be a reasonable thing to do. But things are so wild and whippy, I'd probably have that stop down at 301 somewhere, and you're like, well, it's a $2 stop. I understand, but at the same time, it went to 307. So you would have still gotten your 2 to 1. So that was the early aggressive trade. But now I want you guys, and this is something that's very important when we talk about trading. I use the word relative strength a lot, a whole lot. And there are different versions or levels of relative strength. Sometimes a stock just literally doesn't care what the market could be 5 bars down and that stock's ripping to the moon. All right, news, earnings, whatever, it just doesn't care. Then there are stocks that are correlated, meaning they have a high correlation to the market, but they're slightly stronger or a lot stronger, but they look similar, just stronger similar. Does that make sense? Stronger similar. So this is an example of stronger similar in a way, right? So we have that 3-bar play. The Qs move up 1, 2, 3, 4, 5 bars. This moves up 1, 2, 3, 4, 5 bars. Okay, bar by bar, you're looking at the same. Then the Qs kind of go sideways and pull back. So does Meta. Meta just goes sideways and chops and chops. But one of the key things here about Meta is it does a great job of testing 304 to 304.50 and bouncing, testing, bouncing, testing, bouncing. And then right here, as the market goes higher, this thing rips. So you have a choice here, right? If you believe the market looks higher, which if you look at the trend line on the Qs, the uptrend line, we put in a higher pivot high, and now, and I could probably draw this here, right? I always forget something around here, don't I? I don't know if that's the greatest color to see, but let's make that yellow or something so you guys can see it a little easier, right? We also have an area of support here, don't we? Right, on the Qs. So we put in a higher pivot high right here, and now we pull back to an area that I would consider to be minor price support, and it also happens to be right near the trend line. So from the market perspective, you're expecting a bounce. How big of a bounce, no one knows, but you're expecting some form of bounce. So this is an area where I look at Meta and I go, whoa, I want to do one of two things here. I want to either bid for Meta in the 304 to 304.50 range, or I want to wait till it triggers 305. Now, I'm not looking to marry the stock. I'm looking to scalp it back to 306, maybe 307, but 306 would be the main area because there's resistance there, right? Right there on Meta, there's resistance. So this is where, and we did it today, and I don't have it in here, but where when you bid for a stock on a pullback, Meta has been holding this area. It's been showing pretty good strength, and we expect a market bounce. So when you start putting those things together, the odds start increasing. You're like, wait, this stock was strong off the open. It's consolidating sloppily, but in a bullish manner, in a market that's bouncing off of support at a trend line that we expect to go higher. So this is a good time to start thinking about nibbling. You're not going all in here. Take a third, maybe a half of a position, 304, 304.50. Give it all the room in the world. Give it down to 302, whatever it is, okay? 303. And again, you're in a small lot. And then when the market bounces, you take the bounce. Then the market starts to pull back. Meta starts to pull back. And where does Meta pull back to on a nice, smooth, sequential retracement? Lower high, lower high, lower high, lower high, lower low, lower lower lows, right? And puts in change of color bar, narrow body bar, bottoming tail bar right at support. What's the market do? Pulls back right into this area of support. Little bit deeper than you want, but not terrible. And then what happens? Bottoming tail, narrow body bar, change of color bar right at the trend line. Key factor here, right at the uptrend line, okay? And Meta bounces, retests, market retest, and we're at the trend line. So we are expecting a market bounce. And what do you get? Meta bouncing again. So you get in again between 304 and 305. This is where you might bid for the pullback, or you can wait for it to trigger. You can wait for it to trigger if you're a newer trader. If you're an experienced trader, you might bid for the pullback, give it extra room, and then when it actually triggers, maybe add or raise your stop. And then the market bounces, Meta bounces. That's it. That is how you source out a trade, bar by bar, and decide, is it worth taking this? In this case, it's worth it because the market's in an uptrend, strong, at a trend line, at support, and bouncing. Okay, let's do this again. Trend line bounce, scalp buy opportunity. All right, this is Rivian. Look at the uptrend on this stock, guys. Uptrend line on the left on the 15-minute chart, right? Pivot, 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 pivot. Well, it's not there yet, but I'm expecting a bounce right in this area, okay? Hint, hint, you can't see it. I apologize. I covered it up. I apologize by accident. I covered it up. This is 24. This is like 2360 right there. Where that green line and that pink line are crossing is like 2360. Okay? So, what do? When Rivian starts pulling back in this area, you start nibbling, right? So we got in a little bit early on this. I nibbled some at like 2380. Okay, it was a little bit early, but I also added some at 2350. And I got my cost average down to like 2365, something like that. All right, and this is a 2-minute support area inside of a double bottom 15-minute retest, okay, inside of a trend line, okay? So let's try this for a second, all right? Where did that go? There you go. Let's try this for a second. Okay. I'm blowing this up for you. This is how you need to do this stuff. Okay, right there. Let's put a little border around it so you can see it. Okay? I'll delete it in a minute, don't worry. This right here is that 15-minute double bottom retest. See it right there? That's that 15-minute double bottom retest. You see these bottoming tails? Those are right at the 2-minute retest. And note the bottoming tails hitting the 15-minute trend line. So right over here, the previous day, the stock hit this, it bounced, it ripped. The next time it came back to that same area, like 2370 or 80, ripped. Next day, pulls back to that area, off the open, rips. Next time it pulls back, this is the second bottoming tail, and it rips. Okay, so this is what that 15-minute double bottom looks like when you blow it up. Now let me get rid of it. Okay, that's what it looks like inside here when it says support, and there's that green line right at the trend line, right at 2-minute support after an extended move down. That's how you trade. This is how you take easy money out of the market. And remember, everything's about expectation. Because of the level and depth of this retracement, 100%, I am not, to be clear, I am not expecting 2450. Now, did Rivian go to 2450? It actually did. It bounced up quite a bit. But I didn't need that. I was in at 2365, and it popped, what, 50 cents? I told you guys I'm looking for 20 to 30 cents. If you recall, 20 to 30 cents, we got out at like 2385, 2390. That's it. And I walked away. Walked away. This is how you set up a trade. Nothing happens by itself. Everything happens in conjunction with something else, right? Nothing ever happens by itself, okay? But that's how you set up a trade. Next, relative weakness plus a perfect pattern plus market timing. Okay, now what do we have? Start with the market. We have an Amazon chart and a Q's chart. Now I apologize, these are a little bit off. I should have done what I do with the other one and lined these up better. I apologize, I should have lined them up better. But anyway, so what we have here, the Q's gapping down and the market bouncing. Now guys, what is the first thing that you notice when you look at Amazon compared to the market? Talk to me. The very first thing you notice. I need to hear it from you because it should be slapping you across the face right now. It should be so obvious to you. Ding, 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 ding. Huge relative weakness. This, generally speaking, is a market-related stock, right? Amazon has a high correlation factor to the Qs, okay? It has a high correlation factor. But the first thing I see is gap down in the Qs, move higher. First thing I see on Amazon is gap down, go sideways. Again, Qs, gap down, go higher. Amazon, gap down, go sideways. Then, 1, 2, 3, 4, 5 bars into the day, Amazon decides to go lower. 1, 2, 3, 4, 5 bars into the day, the Qs decide to go sideways. So wait a second, let me get this straight. The market goes dead sideways, Amazon tanks. That, ladies and gentlemen, is the definition of relative weakness. It's relatively weak to what the market is doing. The market's going sideways, your stock is going lower. When the market moved up the first 3 bars, your stock went sideways. You better latch onto this bad boy. These are the types of stocks when I type into the chat log, pay attention to Amazon. We need to find a way in it. Pay attention to this stock. We need to find a way in it. So you had two choices here. You could have taken the earlier trade, which was the breakdown at 127.75, whatever it was, right there. Okay. Or, as I said in the chat log, wait for a bounce on Amazon and look to short the bounce. Look to short the bounce. Well, Amazon then proceeded to give you one of the most beautiful, perfect patterns you could ever hope to ask for. And that is a perfect sequential bounce back up to minor price resistance, which is about a 60% retracement. And then the market hits resistance and the market pulls back. Oh, glorious. And we took this trade, right? We took this trade on Amazon. Okay, we got in right around that area, okay, and Amazon tanked. We were looking for what, 127.10 was it? Something to that effect was our target. And Amazon blew right through that target, and it actually kept going lower and lower and lower. In fact, if I had another picture of Amazon, I believe it got down to 125 something, right? I believe it went down to 125 something, okay? So it went well over $1 past our target. We were looking for like a 50 or 60 cent target, something like that. Okay. And Amazon blew right through it. It's perfection, right? Yeah. It went like 5R or something like that. Okay. Raised with market. Yeah. Exactly correct, Jerry. The comment Jerry's making is most of my recent winners have been relative weakness or relative strength options trades with basket stocks. Most of the time, they're too obvious not to take. And that last part of what Jerry just said is what I want you all to internalize. They're too obvious not to take. Like you're just sitting there and they're like, how do I not take this thing? It's perfect. That's exactly what you're looking for. And this Amazon trade yesterday was perfection. And again, it went another $1 or more past what you're actually seeing here. Okay? Stop making trading so hard on yourselves. Stop making it so difficult on yourselves. Almost everyone in here looks at this and goes, what a great trade. That's amazing. So then the question becomes, why isn't this all you're taking? Well, I don't see that many of them. That's okay. You're not going to lose on that many of them either. Well, yeah, I only see 10 or 20 of those a month. Well, how about you take those 10 or 20 a month and you win on 90% of them? How about that? That's probably better than the 50 crappy trades you're taking. I'm serious. You may only find 15 of these a month, 20 a month. I don't know. But you're going to win on 90% of them. Okay? Exactly right. I just wait until there is money lying in the corner and all I have to do is go over there and pick it up. I do nothing in the meantime. The problem is the meantime, Sophia. The meantime, what is that saying? Idle hands are the devil's workshop. That's what idle hands to traders are. Okay? And that's the problem that traders have. You need to be productive and be scanning and looking and waiting and watching. And I made the comment today on Microsoft. Go back up into the chat log. I made the comment, guys, Microsoft is super strong. We need to find a way in it today. Let's bid for a pullback. And then I wrote later on, if it doesn't give it to us, oh well. That's it. Oh well. I would love for it to give us the pullback. I would love it. And it did twice, thankfully. It did. We got paid on Microsoft twice today. Twice. Exactly where we wanted to. We waited for it to go there and it went there. But yesterday I waited for a stock to pull back and guess what? It never went there. It just kept on going. Oh well. Next. Oh well. Next. You'll find another one, I promise you. All right. Higher time frame support plus a lower time frame double bottom. This is actually a trade someone emailed me. Said, Jared, what do you think of this trade? And I said, you know what? I really like it. So now let's talk about why. Trade on SLB, and we have a stock. If you take a look, the support level is roughly 58.50, give or take, okay? Why? This is a 60-minute chart. It bounced over here. It kind of retested in the $59 area right here, moved higher, pulls back. Gets to that area in a very extended manner. Now remember, this might only be one 60-minute bar, but it's also $2.50. And if you drill down, look inside the chart, look behind the curtain. Remember, we don't just look at the forest, we look at the leaves and the branches and the bark and the forest. We look at it all. You could drill down and you go, oh my gosh, On a 5-minute chart, it's down 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 red bars in a row. Guys, what's 12 times 5? Oh my gosh, it's 60. What's 60? Oh, that's an hour. Oh my goodness, look at that. That's that red bar right there. So you are 12 bars down into a 60-minute area of support where the stock previously bounced. But here's the kicker. It doesn't just have 60-minute support. Let's go to the 5. It has retest 5-minute support. So you're 12 bars down. Could you take the first entry? You could argue to, but it's aggressive. When it retests multiple bottoming tails, now you're starting to get some confidence because you're starting to get multiple concepts happening in an area. So now it becomes a lot more confident to take this trade at 58.50, 58.60. It bounces and you might be done with it. Then it pulls back, puts in a higher low, bottoming tail, narrow body bar, do it all over again. But you're not marrying this stock. You're not marrying this stock because when stocks do stuff like this, they usually don't go all the way back up to 61. They're usually pretty weak. We're trying to scalp the bounce here. From 58.50 to probably 59, something like that, 50 cents, because you're probably only going to have a 25 to 50 cent stop loss. You're looking for 1-to-1 out of this thing. Then it bounces again. Target, prior pivot high, right there, of course, and then you walk away. All happening off the 60-minute chart in conjunction, combination with the 5-minute chart and the extendedness of it and the double bottom retest. Make your life easy. Make it easy. And guys, if you're wrong, it's not going a whole lot lower than this area, right? It maybe peekaboos under and then bounces. Now, is this trade a little more difficult than the last 3 we looked at? Yes, it is. But there's still nothing wrong with this trade. So I wanted to go over those 4 trades because I'm trying my hardest, my best to ingrain and drill into you guys what great trades look like. What is the thought process of a professional when looking at those trades? And the goal for me to do this is so that you will only look at those types of trades. And when you're not sure about something, you'll write it down and review it after the market closes because you might learn something from it, but you won't trade it. You won't trade it until you know. You don't trade stuff that you think is good. You trade stuff that you know is good. It's like a trader getting into something and goes, I hope it goes higher. No, expect it to go higher because it should. Right? If you get into a stock and you do everything right, it should go higher. Sure, 10, 20% of the time you'll be wrong. That's life. We're not perfect. But it should go higher most of the time. Don't ever get into a trade and go, man, I hope this thing works. Then don't get into it. If that's how low your expectation is, I hope it works, don't take it. Expect it to work. And there's another difference. You've heard me say it before. The difference between a novice trader and a professional. A novice comes in every day going, I hope I make money today. A professional comes in and goes, I expect to make money today. That's why I do this job. It's because I expect to make money. When you go to your job every day, do you hope to make money that day? Do you hope your boss will pay you, or you expect your boss to pay you? No, you expect your boss to pay you. I expect the market to pay me. I'm going to work for it, but I expect to be paid for my work. That's the difference. And trust me, it's a completely different mindset of how you approach things. All right, now, 3 major trading mistakes people make. Oh, I caught you guys for a loop. A lot of you guys were like, trade management, money management. Yes, those are certainly mistakes that traders make, okay? Those are more broad-based mistakes that traders make. We're going to go a little more granular, a little more detailed here, okay? And I'm going to bore some of you to death because it's mostly text slides from here on out. Oh, well, deal with it. Tight stop losses are the best way to trade. Get your stop loss to break even as soon as possible. And you can't go broke taking a profit. These 3 things have gotten more traders into more trouble than I can think of. A lot of people have this mindset that, well, the tighter the stop loss, the better the risk reward, without giving any thought to how frequently you might stop out, which means you need that risk to reward because you're going to stop out more often. Lately, as you guys have seen, I am scalping, but I'm giving these stocks monster amounts of room, stupid, ridiculous amounts of room. I am looking for wiggle room in these things because of the type of trades we're taking and where we're taking them. Remember, support, resistance, these are areas. These are areas. Okay? Get your stop loss to break even as soon as possible. This is a fallacy. Guys, think about it for a second. Now remember, I want to be clear here when I say these things. Okay? I'm not saying that some of these things aren't okay to do at times. There's nothing wrong with a tight stop loss, but it doesn't mean the generality that tight stop losses are the best way to trade. It does not mean that. I get my stop loss to break even, okay, frequently. But that doesn't mean it's the best thing to do just because I did it. All right, so we're going to talk about that in a minute here. All right, and you can't go broke taking a profit. No, this is actually how most novice traders go broke. Tell me I'm wrong. $10 winner, $10 winner, $10 winner, $80 loser. What? Now, I may have exaggerated that a little bit, but you get the point. You're sitting here taking half hour, 1 hour gains, but you're taking full stops and you're taking them too frequently. All right? So a lot of people think, well, a winner's a winner is a winner's a winner. And there are times when that's true. There are times that just, hey, if you can win 95% of the time, then small winners work. But for most new traders, they're not good enough to win 80 or 90% of the time. You're just not. So you need to make sure when you win well. You win decent, you win big. Now remember, everything in trading has to do with expectation. There are exceptions to everything. But as general rules, this last one is nasty. So many of you go back, tell me I'm wrong. You go back at the end of the month and you look at it and you're like, you know what? I had enough winning trades / winning days to do well this month. But the size of those losing trades and losing days was so big, it wiped out the majority of my wins. Tell me I'm wrong. Tell me you don't have 15, 16 out of 20 winning days or 20 trading days, but those 4 days wiped out 80% of those wins. You're like, wait, how did 4 days wipe out 12 days of wins? How did that happen? Because you can't go broke taking a profit, right? It's crazy. So again, I want to be clear. I am a much more open-minded trader than maybe many of you think. I'm okay with people doing just about anything in trading if they can show me that it's a systematic method to their madness, not some just randomness. A lot of people get lucky over a few months randomly, and they think it's skill. But I'm okay with people taking a small profit. I'm okay with people going to break even. I'm okay with tight stop losses. You're like, wait, you just told us you're not? I'm okay. If you can show me a track record of success over an extended period of time and a systematic approach to doing so. But if you can't do that, these things are going to be the death of you, right? These things are going to be the death of you. So, tight stop losses. Where did this come from? Likely the idea that a tight stop loss translates into a higher reward to risk, right? What are some of the issues with this statement? Well, it's easier to get shaken out, only to watch it go higher later. That happens, okay? You know what's a great example of that? Well, in terms of not even stop loss, just going to break even, it's probably a better example for the next one, was yesterday. Was it Rivian? I moved to break even. It tagged us by 2 pennies, and then it dropped like, 5R. Now, granted, that's a better example of getting your stop to break even, and I'll probably revisit that, right? Need more shares, harder to get filled. It's true. Guys, now again, I'm not knocking it. Stefan is a wonderful trader. I mean, he has some results that are just off the charts good, phenomenally good. I mean, he is one of the best traders I've met. But one thing can't be done, absolutely unequivocally is impossible to do with Stefan's style of trading, stocks, not options, stocks, is do 1% risk. Can't do it. It's impossible. Unless you have an account that's leveraged 10 to 1 or 20 to 1, if you have a standard trading account that's leveraged 4 to 1, which is a standard account, okay, you cannot do 1% risk on his trades. He'll take a trade on, Apple. Apple's what, $170 stock? I don't know what it is exactly. And he'll have a 20-cent stop loss, 25, 30-cent stop loss. Well, I don't know. Do the math on that. If you have a $100,000 account, you're leveraged to 400 grand, 3,000 shares of Apple, you're barely getting it done with a 25-cent stop. That's $750 risk. You've maxed out your account. You can't even take 3,000 shares of Apple. You can take 2,500 shares of Apple. 2,500 shares of Apple on 25 cents stop, that's $625 risk. Do you see where I'm going with that? I'm not saying it's wrong. I want to be very clear. I am not saying it's wrong. I'm simply saying not only is it harder to get filled, but as a percentage of your account, you're not going to be able to get those 1% risk level trades. Now, could you maybe do it with a $5 or $10 stock? Maybe, right? Spready and whippy stocks will give far more slippage when you stop out, right? If you stop out of a very tight stop loss in a whippy stock, like if you take, for example, I don't know, maybe a $1 stop loss on NVIDIA. Hello. If you stop out, you're taking 30, 40 cent slippage, okay, on NVIDIA, all right? Some stocks need to wiggle, so you're likely to stop out more. And this depends on the type of pattern you're taking, right? If you're taking a 3-bar play or a breakout, it should hit and run. But if you're taking a buy setup with a really tight stop loss, buy setups wiggle, and you might get shaken out of that thing, all right? So the other question is, what are you risking on the trade? You know, tight stops, you can't do quite as much risk as a percentage, but you're probably going to stop out more often. So while you might say to yourself, well, I'm getting to 3R quicker. You are, but you're stopping out quicker also, and you're probably going to stop out more frequently. Okay? So again, I'm not saying it's wrong. Everything in trading is a balance, which means you need to understand the expectation and understand the balance. And the general flaw here is newer traders think they'll lose less with tight stops, right? The fallacy is deeply ingrained to the get-rich-quick community. Oh, I can buy a lot of shares of this stock, and it's a tight stop loss, so I'm not risking as much. And if it pops, I'm going to make a fortune, right? It's the same reason so many traders are drawn to penny stocks, right? So many traders are, to this day, they're drawn to penny stocks, $2, $3 stocks. Why? I got $3,000 in their account, $10,000 in their account, and they want to become a gazillionaire overnight. So they can buy 1,000 shares of a $2 stock with $3,000 in their account, and it pops 50 cents, like I made $500, right? Also, they're cheap, these penny stocks. They're perceived tight stops, and they move a lot, right? For me, for a new trader, it's a sucker gambler's game. Now, I'm not saying for an experienced trader. I just got done telling you, I don't have a problem with people using tight stop losses that are experienced professionals that have a successful track record. But don't come in thinking that this is the answer to all your problems. It is not. Okay, we already talked about that, Ollie. When we talked about risk level, I used the example of the $100,000 account. You won't be able to risk 1% on almost any trade ever. Maybe here and there, but most of the time you won't be able to do it. You'll run out of buying power. 0.5% is about the max you can risk. And on top of it, you won't really be able to be in more than one trade at a time because it eats up so much buying power. Break even and tight stop loss. Break even stops are a mental crutch, period. This is true. Now, I want to be clear. Mental crutch doesn't mean that there aren't times in someone's trading plan or tracking spreadsheet or back testing that the mental crutch actually becomes a profitable mental crutch. There are times when, for example, moving to break even at 1R, that's a mental crutch. You understand that, right? Like that's not based on the chart, but it could be more profitable. The problem with most people moving their stop to break even, they're not moving it to break even because it's the right thing to do. They're doing it because they mentally can't handle the loss. Tell me I'm wrong. It's true. Now, there are times when money management wise, it's the right thing to do. Absolutely, there are times. But the genesis of break even stops is mental. It's a mental crutch, right? Ideally, stops should be based on the chart, not on emotions. We base stop losses off the chart because they give us an edge. We get into charts at certain areas because it gives us an edge. We get out of stocks at certain areas because the edge no longer exists, right? So when you move the stop loss, what are you also doing? You're moving or changing the edge, and that edge might be moved into a negative category. Kind of like this, okay? Kind of like this. For those of you who watch baseball, every once in a while, they'll put up, well, not once in a while, frequently, right? A batter will go up and they'll say, hey, Joe Smith bats 300. But after a first pitch strike, Joe Smith bats 237. Does that make sense? After a first pitch ball, he bats 314. Does that make sense where I'm going with this? So as new information arises, each pitch happens, that person's edge gets higher or lower, right? When you have a 3-0 count, 3 balls, no strikes, your edge might be more than the 300 batting average that you started with. In trading, it's the same thing. You might go into that trade, and let's say you win 72% of the time, and then you change your stop loss, raise your stop loss, okay? And now all of a sudden, you don't realize you're doing it, but your 72% edge goes down to 34% now. And you don't even know you're doing it because you don't track your trades, you don't backtest your trades, you don't do any of that stuff. But you raised your stop loss because emotionally you couldn't handle it. Now, I want to be clear. I'm not saying that sometimes that mental crutch isn't profitable. And you may have backtested that mental crutch moving to break even at 1R, and it's actually a bona fide statistical advantage. Who I'm speaking to are the 90% of you out there who don't track your trades, who don't backtest your trades, and who don't do statistics. That's most of you. And you just raise your stop loss because you're like, I don't want to lose on this trade. I got to get it to break even. That's just a mental crutch, right? The chart has no idea where break even is. It's just a mental crutch, okay? It's a reaction based on having a stronger fear of loss than a hope for gain. Write that down. It's a reaction based on having a stronger fear of loss than hope for gain. Why do traders let losers run and cut winners short? Ego and fear, that's it. That's it. Ego and fear, that's it. Give it some thought, guys. If you're going to use that as a mental crutch, wouldn't it be advantageous to know if it's statistically reasonable for you to use that mental crutch? And you might go find out after going back testing, and this takes note-taking, journaling your trades. After 100 trades, you look back and you go, wow, every time I move my stop loss based on emotion and not the chart, I lose more money than I make. Or you might go back and go, every time I move my stop loss after a 1R pop to break even, it's actually beneficial to me. I don't want you to think about it. I want you to know it. Do the analysis. Do the statistics. Like sabermetrics in baseball, do the analysis. And like I said, there could be some exceptions, but there are a few. All right? Now, can't go broke taking profits. It's just completely erroneous thinking. It's literally how most people go broke. It says it at the bottom. This is exactly how many traders do go broke, okay? It sounds good in theory, right? But then again, so does communism. Oh, I'm sorry, Sophie. I had to put that in there. I'm kidding. I'm just joking. Relax. Calm down. Breathe. Woosah. All right. In reality, the only way this works is if you never have losing trades, right? It's true. The problem here is new traders don't really have a track record of consistency. So the fact is they don't really know how often they win. So they don't have an understanding, okay, how much they need to win when they win. Think about what I just said. Because they don't know really how often they win, they don't also have an understanding how often they need to win to make money. Okay? So, when you think about it, cutting those profits short, because basically what you're doing, you're now allowing your losers to have a larger impact on your P&L than your winners do. And to be honest, your winners should have a larger impact on your P&L than your losers do. Unless you're a professional trader who's been doing this for a long time and you're batting 80, 90%. Then the occasional loser you do have can be bigger than the winners. But for most of you that are batting 40 to 60%, and that's most of you, 40 to 60%, you need your winners to be bigger than your losers. They have to be, right? So balancing your win-loss ratio and your batting average is key. This creates a positive expectancy. Some of you that are new are like, I don't even know what expectancy means. It means the amount of money you make or lose, but generally the amount of money you make on every trade you take, not just the winners, not the losers. You want an expectancy that's between 0.2 and 0.5. Like, what does that mean? That means if you're risking $100, that means you make between $20 and $50 on every trade you take, including the losers. Okay, now we can do another lecture on expectancy later, but you need a positive expectancy between 0.2 and 0.5 to be a great trader. Okay, well, obviously it has to match with a batting average, but if you can make 0.2 to 0.5 R on every trade, that includes the losers, you'll be fine. You'll do very well in this business. But many of you don't have a positive expectancy, and the reason you don't have it is because you take your profits too soon. You sell your winners quick, and you take full advantage of your losers. Let's say it again loud and proud. You sell your winners too soon, but you take full advantage of your losers. You make sure you get every last penny taken out of your account when you lose, but you sure as heck make sure you don't take a lot of profits when you win. Okay? Most traders do it out of fear. That's it. When they start seeing a little bit of green, they're like, "Oh my gosh, it might start pulling back, and the green might turn to red. What am I going to do?" When it starts going immediately red against you, you go, but if I sell it here, it's a loss. It could still bounce and get my money back. You have literally counterproductive thinking. You should be thinking the opposite, but you're not, and you're doing exactly the wrong thing. Okay? It gives you an excuse to sell, gives you an excuse to break your plan, gives you an excuse to hold on to the losers because it's not a loss until it's realized, gives you an excuse to sell the winners because you're about to realize gain. It's nasty. It's a mental mind F U blank K. Okay? That's what it is. And you're all buying into it. You're buying into it. You need to do the opposite. Okay? I hate saying it, but it's a truism. It's like being an average person. You're all going through life doing the opposite of what you need to do to be truly successful in the world. Save too little, spend too much. Oh my gosh, that's the same as taking full advantage of your losers and cutting your winners short. Save too little, spend too much. Okay? That's a great way to go to the poorhouse. Traders do the exact same thing. Cut the winners short, make sure they take full advantage of those losers. Okay? Now, all too common. Trader has an education, professional trading strategy or otherwise. They've become technically proficient. They can tell you what a bottoming tail is, what support and resistance are, what a volume spike is, what relative strength and weakness is. They're largely proficient, technically speaking. Usually have more winners than losers. Batting average is 50, 60%. That's what BA is, batting average. Okay? Usually able to create a compelling gap list and even locate genuine patterns. Okay? Overall, this trader feels good about their approach and their progress, as they probably should feel. They are technically proficient. They have a batting average that appears reasonable. They're creating gap lists and locating patterns, and overall, there's a lot of goodness in there. There's a lot of good things in there. All right? But they are all too frequently breaking even. They are all too frequently break even at month's end. I guess it does make sense. The way I read it didn't. They're all too frequently break even at month's end. Okay? Next month will be better. I'm so close, I can feel it. You might want to pull a mirror out right now. Go ahead. I'll give you a minute. Go find a mirror. Maybe, just put your iPhone up there and just hit the camera button, the circle so it looks back at you. And just look at yourself for a second. Okay? Is that you? Break even at month's end. Next month will be better. Oh, I'm so close. If I could just fix one thing. Or one of my favorites. I love it. I'm sorry. They go losing month, break even, losing month, break even, losing month, break even. Okay, 4 or 5 months in a row. Then they have a 10 or 20 hour month. I get an email. Jared, thank you so much for that lecture you gave 2 weeks ago. It really hit home with me. I took it to heart. My gosh, your lectures are incredible, man. They're awesome. And you know what? Dude, I'm up 18R this month. I finally feel like I've turned the corner. And a lot of it had to do with that lecture you just did. It was incredible. I was doing all those things you said, breaking even, and next month will be better. And I made 18R. Everything's going to be different. Next month happens, they do the same shit. They just didn't realize that you can be lucky too. Now, some of those people go on to be very, very successful, and they have 6, 12 months of profitability, and then that changes their life. But there's a lot of those people that I get emails from 3 months after that go, I don't know what happened, Jared. I thought I had it figured out. Ollie, if you only knew, if I could just give you a synopsis of all the emails I get every day, we'd be here for 6 hours. All right. The comments I get from people, it's astonishing. And I'm looking at it and I'm going, well, I've been hearing from you for the last year and you've been telling me all your problems and you have one good month out of the last 10 and you think that that's it. It's like, hey, I went to the gym every day this week. I'm going to be a marathon runner. Well, slow down. Look, you're not there yet. You're not there yet. Okay? Get back to me in 6 months and let me know how that 6 months went. And then we'll have a better understanding of whether or not you really turned the corner. And I'm hoping for you. I'm pulling for you. I really am. But let's not get ahead of ourselves. Okay? So you need to think about why you do what you do. What's the cause of why you do what you do? Okay? Oh, Jordan, everyone does. They go run on the treadmill when they live in Minnesota. Come on, man. You got to go to the gym if you want to be a marathon runner in Minnesota. All right. And Moises does too. Now, you want to ask yourself, are your belief systems hurting your trading? Now, I'm going to wrap this up soon, but I want you guys to take a look at this. Okay? Peter Bernstein, no idea who this is, cites an experiment by Richard Thaler in which students were told to assume they had just won $30. They were offered a coin flip upon which they would win or lose $9. So they got $30 in their pocket, and flip of a coin, they either have 21 or they have 39, right? They're either going to lose $9 and go down to 21, or they're going to win $9 and go up to 39 bucks, okay? 70% of the students opted for the coin flip. 70% of the students opted for the coin flip. When other students were offered $30 for certain, guaranteed $30, okay, versus a coin flip in which they got 21 or 39. So the choice here is you have $30 guaranteed, or you can flip a coin and get 21 or 39. Only 43% of the people opted for the coin flip. Now, some of you are confused right now. You're like, well, it's the same thing. But it's not the same thing, right? One, you already have the $30. The second one, you have the choice of getting the $30 or flipping a coin for 21 or 39. Now, some of you are still confused. Like, you're right, Jared, I'm confused. How things happen matters, but it shouldn't. Remember that lecture? Well, some of it has to do with this, okay? Some of the problems of interpreting human behavior in the face of risk has to do with the problem of people making decisions on the basis of subjective assessments of probabilities, which may be quite different from the objective or true probabilities. Tell me you've never done this before. I've done this a gazillion times, especially in trading. Making decisions on the basis of subjective assessments of probabilities. Well, everything you do is subjective unless you track it, right? If you don't have a spreadsheet that tracks this pattern, this trade, this time of the day, then it's subjective. Now, could there be truth to the subjectivity? Yes, but you don't know it as truth because you didn't track it. Does that make sense? Okay? It is. It's a very subtle but interesting difference. But look at the difference in the number of people. Nearly half took the option, right? So you ask yourself, how many trades have you taken on pure subjectivity? It looks strong, so it has to go higher. Oh my goodness, how often do I hear that? They crushed earnings, so I know this will work. Where's the CAZ-CAS? Yeah. Have you seen the new XYZ product? It's killer. That stock's ready to blast off, take off. Okay? It's so extended, it has to pull back. Or bounce, whatever, right? I'm going to add more shares on the way down because the fundamentals are just so good. You've never done any of these things, or at least used some of these things to justify a crappy trade, or justify staying in a trade you already took that's crappy and didn't take your stop loss on? I mean, my goodness. We've all done it to some level, especially on those bag holders. You know, when you take a decent trade, but then you don't take the stop loss, and all of a sudden you're like, well, they crushed earnings. It's going to bounce. I'm going to hold on to it. Oh my gosh, it's down 9 days in a row. It has to bounce. I'll get out of this thing for a lesser loss. Bag holding, okay? So when you look at these things, you got to ask yourself, who is really trading? Your subjective mind or your objective mind, right? And there are people that are born a certain way. I tend to be more of that engineer type mentality. And that hurts me in other areas of business or other areas of life. Okay? I may have less empathy for somebody or sympathy for somebody when I look at the numbers. Someone else might be overly emotional and subjective and much less objective, and their emotions rule their world. Right? We all fit on some area of the spectrum or bell curve. The question you have to ask yourself is, where are you on that? And that's the challenge about being objective, right? You could say, objectively, I'm very subjective. That would be potentially an accurate statement for somebody. Now, the question then goes, what are you going to do about it? You know you're largely subjective, or you know you're largely emotional. So how do you move yourself closer to the center of objectivity, right? And I think a lot of people don't do this. And in doing so, they cost themselves a lot of money because they don't understand who is actually trading. And that is really the sole, I guess, atom to trading, if that makes sense, right? The question that needs to be answered more than any other question is, who is really trading? New traders have no idea what that even means. They're like, well, it's me. Of course it's me. What are you even talking about? Are you a cuckoo? Did you bump your head, Jared? You'll understand after 3, 6, 9, 12 months when I mean who is actually trading. Because you think it's you, but in reality, it's a version of you, right? It's a version of you that you're not familiar with because you've never had to do it before. And you've heard me use this commentary frequently. Most people do better with rules and guidelines that are enforced with consequences. You go to work, your boss says, I need you to do this spreadsheet. I need it done by this day and this time. And if you do that, here's your salary. And most people operate much better under those circumstances because they're very clear, concise, right? You know what it is, spreadsheet. You know when it's due, tomorrow at noon. And you know what you're going to get paid for it. Bam, bam, bam. And most people operate very nicely. Now, they like to bitch, moan, and complain about it because that's humans, but they operate better and they're more efficient when they're told what to do. When you are by yourself and no one is telling you what to do and there is no deadline for it and you don't have to scan for charts, you can surf the internet while you're trading and you don't know if you're going to get paid. There's a lot of ambiguity there. A lot of people get lost in the fray. And the market takes advantage of that. Lack of concentration, lack of objectivity, lack of focus. Most people are better employees than bosses. I'm sorry. I know everyone out there goes, not me, not me, not me. That's why I'm here, Jared. And that's why you'll be gone next month too. Most people are better employees than bosses. To be a great trader, you need to be the better boss. And there's no one looking over your shoulder. It's just you. And it comes down to these types of belief systems and whether or not you can get past the subjectivity that we all have. We all have a little bit of it. You need to be as objective as possible. And then once you're objective, what are you going to do about it? Because you might be objective, but you still have a problem fixing your problem, right? At least you're honest about it. You're like, that's 50% of the battle, right? Understanding what the problem is 50%. The other 50% is fixing it. So a lot of traders get to that point of, yeah, I know what the problem is, but they don't get to the point of fixing it. Okay? So you have to ask yourself those types of things, all right, when you trade. So if we go back in quick summary, the three mistakes or fallacies or things that people struggle with. Tight stop loss is the best way to trade. Get your stop loss to break even as soon as possible. You can't go broke taking profits, but we just discussed why and how a lot of people do go broke doing those things. And we also discussed belief systems and why you do some of the things that you do. Guys, there's a whole chapter in PTS on belief systems. Okay? We talked last week about making your trades better, easier, right? The Qs, AMD. You remember this trade? I showed it last week. I'm just showing up so you can take a screenshot. Next, we talked about this trade on Tesla last week. Guys, make your trading easy. Stop complicating the charts, stop complicating the patterns, and stop complicating your mind. All right? Trading can be an unbelievably rewarding business. Freedom, flexibility, time, money, like it's limitless. It really is limitless. I mean, look at Cass. 54 years old, he just retired. Okay? He said, yeah, I'll trade part-time. He goes, I hit my number. I want to spend more time with my kids. I want to spend more time riding his motorcycle through the canyons. More time on the beach, more time traveling. Those are the beautiful parts. Look at Aaron. He's a farmer. Farming's difficult. Well, in the next 2 to 3 years, he's going to probably have himself a bunch of rental properties. He's already exceeding his farming income. He's making $20,000 a month. Putting in hard work. My point is, the freedom, flexibility it gives you is incredible. But when done improperly, when done wrong, it can be the most frustrating, most devastating, most costly business that you can ever try. Ever. When done wrong. So the extremes are there, right? The positive side is amazing. The negative side is wow bad. If you're one of those people that just YOLOs it, right? If you can find the balance between understanding yourself, who you are and how you react to certain situations, and combine that with good, clean charts that show relative strength at trend lines, bottoming tails, market timing, you can do that and put that together, the world is your oyster, and there's nothing you can't do. All right, so I hope you guys learned a little bit more about how to be better traders. I'm Jared Wesley of Live Traders. We'll get back at it again next week.